Roughly one-third of your retirement account is a bet on artificial intelligence. You did not choose that. Nobody asked you. It happened quietly. Inside the index fund you were told was the safe, boring, diversified option. Because the 7 largest companies in America now make up about 31% of the entire S&P 500. That is a higher concentration than the top 7 had at the absolute peak of the dot-com bubble in March of 2000. And big tech is on track to spend north of $700 billion building AI infrastructure this year alone. So everyone has landed on the same conclusion. This is a bubble. It is 1999 all over again. And when it pops, it takes your retirement with it. Except there is one number that completely breaks that comparison. So let's follow the money. Because to understand whether this is another dot-com, you have to understand what actually killed the first one. Back in the late 90s, the internet was obviously going to be world-changing. Everyone was right about that part. What people got wrong was the financing. Companies were being valued at billions of dollars while generating almost no revenue and, in a lot of cases, no product. Pets.com is the famous punchline, but there were hundreds of them. The entire model depended on one thing: a continuous stream of new investor money coming through the door to keep the lights on in businesses that had never made a profit and had no realistic path to one. Then the outside pressure arrived. Microsoft lost a major antitrust ruling. A few high-profile accounting scandals blew up. Interest rates rose. And critically, a handful of financial journalists started running the actual math on how many months of cash these companies had left. Once investors stopped writing checks, the businesses did not slow down. They simply stopped existing because investor money was the only thing they ran on. The Nasdaq lost roughly 78% of its value from peak to trough. It took 15 years to get back to where it started. So that is the template everyone is pattern matching to right now. And on the surface, the resemblance is genuinely uncomfortable because the surface level parallels are not imaginary. Concentration is the big one. In 2000, the top 10 companies made up around 25 to 27% of the index. Today it is closer to 35 or 36%, depending on how you measure it. That is not a rhyme. That is worse. One narrative is carrying a larger share of the American stock market than the internet narrative ever did. Then there is the capital expenditure. In the late 90s, telecom companies laid enormous amounts of fiber optic cable across the country on the assumption that internet demand would grow forever. They were right about the demand. They were catastrophically wrong about the timing. By 2002, an estimated 90+% of that fiber was sitting unused. It was called dark fiber, and it bankrupted companies that had borrowed billions to install it. Today, hyperscalers are spending $700 billion a year building data centers on the assumption that AI demand will grow forever. Same shape of bet. Current earnings funding future capacity with returns that are not yet proven. And the returns question is real. MIT research found that around 95% of enterprises deploying generative AI were getting effectively zero measurable return on that investment. OpenAI is reportedly projecting cumulative operating losses in the range of $140 billion through 2029. Its valuation went from roughly $80 billion in 2023 to $730 billion by early this year. That is a 9-fold increase in under 3 years for a company that loses money on nearly every customer it serves. There is also the circular dealing, which is the part that looks worst in a headline. Nvidia invests in OpenAI. OpenAI commits to massive compute purchases. Those compute providers buy Nvidia chips. The money goes in a circle and every company in the loop reports it as revenue growth. Written down like that, it sounds a lot like an accounting trick dressed up as an industry. So, the bubble case is strong, which brings us to the number that complicates all of it. Nvidia earned more than $120 billion in net income in its most recent fiscal year, on revenue of roughly $216 billion. Stop and sit with that, because it is the whole argument. Nvidia is not Pets.com. Nvidia is one of the most profitable companies in the history of capitalism. It is generating something like 5 times the free cash flow that Microsoft was generating at the peak of the dot-com bubble, and the valuation multiple reflects that. Cisco was the Nvidia of 1999. It briefly became the most valuable company on Earth, and at its peak, it traded at somewhere around 140 times forward earnings. Nvidia currently trades at roughly 32 times trailing earnings. That is expensive. That is not remotely the same universe. This is the part almost nobody gets right in the bubble conversation. The dot-com crash happened because the market was pricing companies on stories instead of profits. This time, a huge amount of the run-up has been carried by earnings that actually showed up. The companies got more expensive because they got dramatically more profitable. Not only because people got more excited. That is the kind of thing that never makes it into a headline, because the real story is almost never the one the market is telling. It is the one buried in the balance sheet. If you want to understand these numbers before the talking heads simplify them, hit subscribe. And then there is the financing, which is the single biggest structural difference. Dot-com companies burned investor money because they had no other money. Today, the firms driving this are sitting on the largest corporate cash reserves ever accumulated. Microsoft, Alphabet, Meta, Amazon, Apple. These companies spent the better part of 2 decades stockpiling cash, partly because of old tax rules that made it expensive to bring overseas profits home, and partly because they were so dominant in their markets that they genuinely could not find anything worth spending it on. Now they have found something to spend it on, and the money going into data centers is not primarily borrowed, and it is not primarily retail investors. Netted out, these companies are still paying more money out through dividends and buybacks than they are taking in from investors. That is the mirror image of 2000. It also reframes the circular dealing. Yes, it inflates the numbers, and yes, you should be skeptical of it. But there is a defensible version of that strategy. If you genuinely believe a technology is going to be worth trillions, and you do not know which layer of the stack captures that value, you buy exposure to every layer. If AOL had put money into Amazon in 1999, we would call that visionary rather than suspicious. Investing up and down your own supply chain is either self-dealing or portfolio construction. So, same bet, much stronger balance sheet. But here is why none of that means you are safe, and this is the part that actually matters to you. Strong foundations do not guarantee a good building. These companies having trillions in cash does not mean that lighting hundreds of billions of it on fire chasing one bet is a good idea. It only means the companies themselves probably survive being wrong. You might not, because share prices right now are elevated on the expectation that AI eventually generates trillions in revenue. If that timeline slips, even by a few years, those prices get repriced fast. Microsoft is not going bankrupt in that scenario. Its stock can still fall 40%. And with the Magnificent Seven making up roughly a third of the index, that is not a tech sector problem. That is a your retirement account problem, transmitted directly through the index fund you were told was the safe, boring, diversified option. That is the actual risk, and it is genuinely underrated. Millions of people who deliberately avoided picking individual stocks, who did the responsible thing and bought the whole market, are now holding a portfolio that is about 1/3 bet on artificial intelligence. They never made that decision. Index concentration made it for them. And there is a second-order version too. In 2000, the fiber that got overbuilt eventually got used, and it made the modern internet possible. Society won. The specific investors who financed it lost almost everything. Those two things can absolutely both be true at once. AI can genuinely transform the economy and still destroy an enormous amount of shareholder capital on the way there. So let's answer the question honestly. Is this the next dot-com crash? Probably not in the way people mean when they say it. The companies at the center of this have real revenue, real profits, real cash, and multiples that are a fraction of what Cisco carried in 2000. The financing is not built on a debt pyramid or on a constant infusion of retail money. That combination makes a total 78% NASDAQ-style collapse considerably less likely. But a serious correction, a repricing of overbuilt capacity, a brutal shakeout of the money-losing layer, a multi-year period where the index goes nowhere while earnings catch up to prices, that is very much on the table. And index concentration means it would hit far more ordinary people than 2000 did. The honest framing is the one the executives themselves use, more or less openly. They are wagering hundreds of billions on a roll of the dice. If it hits, the payoff is measured in trillions. That is a risky bet. It is not automatically a stupid one, and they can afford to lose it. The question worth asking is not whether they can afford it, it is whether you can. Understanding what these numbers actually mean, not what the headlines tell you they mean, is how you protect yourself. If this breakdown helped you see the AI trade differently, hit that like button, subscribe to the channel so you never miss an upload, and ring the notification bell while you're at it. This is how modern money works. And right now, it's not working for you.